Welcome, and thank you for joining us. I'm Kevin Kane of Stowe and Degon. This is our third update now on the PPP program, with an added focus this time on the employee retention credit. We're coming close to the deadline at the end of March for filing the PPP2 program. So we have a couple of things we do want to talk about today. The PPP and employee retention credit will cover. So we'll welcome your questions, and you can ask them two ways. Please type them into the Q&A box. Wait until the end of the webinar and ask directly. Also, just raise your hand and our moderator will ask you to unmute your microphone. If we cannot answer your questions during the webinar, we will subsequently respond to your question by mail. The presentation today is being recorded, so if you would like a copy, please email us after the webinar. And after the webinar, a short survey will appear on the screen. Please take a moment to answer these questions. They've been helpful to us so far. Our responses are anonymous and will help make sure you get the most from the webinar series. The key point of our disclaimer is really this. The process for PPP has been really fluid. We've been following a number of the evolving changes that have taken place. And even though we're within 5 weeks, you want to keep an eye out for things that may yet change or be fine-tuned in some way in terms of the proclamations that come out. So please make sure you review the decisions that you make regarding it with your counselor or advisor. So at this time, I'd like to turn the program again over to Marty Croyle and Prasanna Kadambi, who have guided our first two also. Each of Marty and Prasanna are partners with Stowe and Degon. Marty?
Thanks, Kevin, and welcome everybody to our third and final update on PPP and the ERC. A couple of weeks ago, we were debating whether or not to have this third webinar, because we know a lot of people have already applied for forgiveness on their PPP1, and a lot of people have already applied for their PPP2 loans. But there are still a lot of companies out there that haven't done either, and we need to walk through that with them as well. There's a lot of new questions about the employee retention credit, and we'll dive into that today. So we thought it made sense to do one more dive. And we may repeat some things that we had in the last webinar, but I think those things will be well worth repeating. So let's get started. Today we're going to talk about we're going to break our talk down into 3 segments: everything PPP1 and PPP2. I'll take care of that, and then Prasanna will take over and talk about the tax side of the PPP and the ERC topic. And then he's going to talk about the interplay of PPP and the ERC program. And then we'll leave time for Q&A. And I know that we will stick around as long as anybody has any questions. So let's get started. PPP1 and PPP2, it's also called first draw, second draw, whatever you want to call it. For the sake of argument, we're calling it 1 and 2. Just it makes our slides easier and takes up less space. This whole PPP process is overseen by the SBA. Okay, and I think everybody knows about that. The employee retention credit is a payroll tax credit, and is overseen by the IRS. And the reason that I bring this up is that a lot of people confuse these two. The SBA and the IRS do not always have the same definitions, and they also don't seem to have the same rules, and there's a reason for it. They're different bodies and they look at things differently. So just a quick history, a recent history. On 12/27/2020, just a couple days before year end, 2 big bills were signed into law. And they did a lot of things, but the 3 most important things they did was they allowed the deductibility in 2020 returns of eligible expenses, think payroll, think rent, think utilities, that were paid for with forgiven PPP1 loans. That was a big deal. Prasanna is going to touch on this in a little bit. The second thing that these laws did was they created a second loan out of the PPP. Okay, they said we're now going to go to PPP2 and allow people to apply for those loans. And third, and also importantly, they said that PPP borrowers could now be eligible if they met certain criteria, that they could also get the employer retention credit. That was a big deal. So those are the three topics we'll cover. So over the next 35 minutes, Prasanna and I will do that, and then we'll take questions. So the latest on PPP1 forgiveness and PPP2 loan application. So in general, you have 10 months from the last day of your covered period for the PPP1 period. And that's going to be different for every borrower. It's 24 weeks from the day you started your covered period, and everybody's covered period started at a different time. But let's not forget, you got to file for this thing, okay? The good news is you got the loans. The good news is that we believe most loans will be forgiven, but you still got to file for forgiveness. We don't want anybody to forget it. So here's an example. If your covered period ended around October 30th, you've got until August 30th to file for it, August 30th of 2021. But we don't recommend that you wait that long. And only in a couple of occasions or circumstances do we recommend that you hold off filing for forgiveness at the moment. We recommend get this done, get it behind you. We're going to talk briefly about something we talked about in December. It's the accounting for the forgiveness. And we've had a couple of clients who think they can write off their loans at the end of the 2020 calendar year off their balance sheets, even though they haven't even filed for forgiveness yet. They expect they're going to get forgiven, but they haven't been forgiven. So I want to briefly go through the rules for the bookkeeping or the accounting for your financial statements. When you received either PPP1 or PPP2, you're going to record cash, and you're going to set up a liability called PPP1 loan, PPP2 loan in your liability section of your balance sheet. And you're not going to write that loan off to other income until you get a letter from the SBA that says you've officially been approved, and they stipulate the amount of the loan that's been forgiven. Until you get that letter, you need to keep the liability, the loan on your books. So what we believe is that since most borrowers did not apply for forgiveness early enough, and therefore they did not get SBA forgiveness before the end of 2020, we believe that most borrowers will have this PPP loan still recorded on their books at the end of 2020. Okay, that's a pretty simple concept, but we've had some confusion there, and we just wanted to touch on that one more time. The calculation, the PPP1 and PPP2 rules for applying for loans and for applying for forgiveness, they're virtually identical. There are some changes, but they're very, very similar. And anybody that was intimate with filing for the first loan and they filed for the second loan, they probably have seen the second time around was a lot easier. They understood the terms and all that kind of stuff. Secondly, you're going to accumulate your eligible costs. Think payroll, think employer health benefits, think rent, think utilities. You're going to accumulate all of those during your chosen covered period, okay? And you're going to come up with a grand total of those numbers. 60% of your PPP loan must be spent on payroll. That means that only 40% of your PPP loan can be spent on non-payroll things. Think rent, utilities, etc. The forgiven loans will not be taxable. We all knew that from day one back in March and April when the CARES Act came out, but now the eligible expenses will be deductible. That's big news. What we talked about in our last program was everybody should be using the 24-week period. In PPP1, you got to choose between an 8-week covered period or a 24-week covered period. Now, I can tell you that I recently talked to a client that was still thinking about using the 8-week covered period, and they were going to be having to pay back some of their loan because they couldn't spend all of the eligible expenses before the end of 8 weeks. So we went through this 24-week thing. The client has adjusted their records, and now they're going to get 100% forgiveness. So in most cases, we believe that a borrower is better off on PPP1 for the forgiveness part to pick the 24-week period. And what we said to you all last month, and what the AICPA has been telling us, the American Institute of CPAs, is that instead of burdening all of your forgiveness form with rent, utilities, employer medical, and all the other non-payroll items that are eligible, just throw your payroll in. And so what we've been telling people is take your covered payroll amount, payroll expenses from your payroll, outside payroll companies, and throw that number into your payroll line on your forgiveness form. And in this situation on this slide, we've got 3.6 million of payroll. We only have a loan of $1.6 million. We've got $2 million of cushion. And guess what's going to happen? We're going to get full forgiveness. Now, if you have a forgiveness calculation, and if you qualify for the employee retention credit in 2020, you may not want to put the entire 3.6 million of payroll on your forgiveness form. And you may want to include some other eligible expenses like rent and utilities. Why? Because you can't use the same payroll expense dollars on both the PPP side of things and the ERC side of things. So you might want to adjust your 24-week calculation to something like this. You can see down about the 5th or 6th line, payroll was 3.6 million, now it's 1.8. And we've thrown in a few other items, okay? And we come down to a grand total of $2 million worth of eligible expenses that exceeds our PPP loan amount. And so we have some cushion, and the bank and the SBA is going to fully forgive us, okay? So if you think you qualify for an ERC credit, and Prasanna is going to get into that in a few minutes, you might want to hold off your forgiveness calculation until we have a chance to walk through this with you, because everyone's going to be a different facts and circumstance, okay? If you have already filed your forgiveness form for PPP1, and you included your entire amount of covered payroll, the equivalent of the 3.6 that we just had, don't despair, because the American Institute of CPAs has petitioned the IRS and the SBA to allow people to allocate some of that excess payroll that they didn't really need to report in retrospect on their forgiveness form, and save it so they can allocate it to their ERC calculation. If I was a betting man, I would think that's going to pass, but it hasn't as of yet. So that's why we're asking people to just be a little patient until we hear from the IRS on this. So as of a week ago, about a week ago today, the IRS had not responded to that question yet. So let's talk a little bit about the PPP2 loan application and forgiveness. Again, many of you have already done this, and many of you have gotten your money, but a lot of you haven't. So first we have to decide if you're eligible. Not everybody's eligible, and PPP2 is more restrictive than the PPP1. Then we're going to go through the calculation, very similar to PPP1. We're going to go through the application form that you have to fill out, and then there's a few other things we'll talk about. So it's easy, to me, it's easier to look at whether you're eligible by first looking at all the ineligible companies. So take a gander down this list, and I think, you know, this will, if you check any of these boxes, you cannot apply for the PPP2 loan. Okay. Now, to be eligible, let's look at the things that it's more restrictive, as I said. The maximum number of employees that a company can have is now 300. That's a general number. That's a general rule. It used to be 500 in PPP1. So we have a client that has 450 employees. They got PPP1 loan, a big one, and now they don't qualify because they have more than 300. This is the big thing. This is a quantitative calculation. What the SBA is saying is we want to make sure that companies have really been hurt if we're going to give them a second loan, okay? And so their calculation is you have to have seen your gross receipts, think revenue and other types of income, have dropped by 25% or more in any quarter in 2020 as compared to that same quarter in 2019. And if you didn't have a drop in 25% or more in any of those quarters, you don't qualify. As in PPP1, when you file for your application to PPP2, you've got to certify to this this comment. And basically what you're saying is, we have enough uncertainty in our business that we need this loan, okay? And what we recommend everybody is, probably everybody could defend this, If you got audited, maybe they would, the SBA would come in and tell you you didn't have enough economic uncertainty. I don't know. But we're telling you, we're just imploring all of our clients to document everything. You know, we had this contract canceled. We had this contract delayed. We've got 3 people that won't travel because they're afraid of COVID. We still don't know what's going to go on with the vaccinations. So we still need this money. Okay. So document that. Gross receipts, sale of products and services. It's either on the cash, it's either received or accrued. This is what the language says. And then in parentheses, it says in accordance with the entity's accounting method. So we were hoping to get more guidance on this. We get a lot of questions. Hey, so I have accrual basis financials. I have a tax return on a cash basis. Which one can I use? Because I pass on one and I fail on the other. You know, there's a lot of gray here, okay? The AICPA has said to us, don't overthink this, be consistent. If you're gonna use the accrual for each quarter, then use the accrual for both years, okay? We're also gonna add in interest and dividends, rents, royalties, and other things like that. It's going to exclude your receipts are going to exclude any forgiven loans from PPP, and it excludes all capital gains and losses. So you're going to add up all those numbers for each quarter in 2020 versus each quarter in 2019 on the same accounting basis. And if you've got a 25% or more decrease, you're eligible. So again, it's the 25% gross receipts. If you are a smaller company and you don't want to do it by quarter, you can do it for the entire year, okay? So the calculation, the loan is now going to be the same way as before. What we did on PPP 1 is we went back to 2019. You calculated your average monthly payroll that you had in 2019. You multiplied that by 2.5, think 2.5 months or 10 weeks approximately, and you multiplied that by 2.5, and that was the amount of your loan. Now what we do this year is you can either take the average monthly payroll in 19 or 20 and multiply it by 2.5. And for a lot of people, if they're using the same bank, they're using the 2019 data, they don't have to resend a lot of backup to the bank because the bank already has this, okay? And we also think that probably more companies are going to use their 19 versus their 20 monthly average payroll because they probably had higher payroll in 19 than they did in 20 because 20 was when we were all dealing with COVID so much. One big change in PPP 2, first time around, a taxpayer could get $10 million, general rule. Now it's $2 million. So that's a big restriction. The average monthly payroll calculation for either 19 or 20 is calculated the same way as it was in PPP 1. There's a couple of slight differences, but it really doesn't change a whole lot. And if you have a NAICS code that starts with 72, that means you fall inside the hospitality and restaurant business, food and beverage business. They're allowing you to borrow 3.5 times your average monthly payroll because they feel that those businesses were extremely hampered and hammered in 2020. So those are the general rules for calculating the size of your loan. The application form, this is very important. Kevin mentioned this earlier. March 31st, 2021, don't wait till the last minute. It's form 2483-SD. It's going to look very similar to the one you filled out before. Very similar, okay? Fill it out. If you need help, call us, let us know. We can walk you through it. Other provisions. You can file for your PPP 2 loan applications before you apply for your PPP 1 loan forgiveness. It's in the SBA language. It's clear as day. There are some banks that are not following that rule. I don't know what to tell you there. But technically, you do not have to file for forgiveness before you file for your loan application for 2. Filling out, as I said this before, if you fill out your application with the same lender and you're using the same 2019 payroll data, the ease of, there's a whole lot less work that you have to do to send in. Now, if you're unhappy with your bank and want to change banks, feel free to do that or find another lender. You're going to have to go through the same process you did the first time around, giving payroll reports and backup documents and so on and so forth. In PPP 1, the borrower got to choose a covered period of 8 or 24 weeks. Now in PPP 2, you can choose between 8 and 24 weeks. You can pick 14, you can pick 18, there's 22. It's up to you. Our recommendation is you pick a long enough period of time that you will clearly have enough eligible costs paid for that will far and exceed your loan. So your PPP loan, so that you get full forgiveness, okay? And one of the new provisions that makes this less restrictive is 501c6 entities are now allowed to borrow money in PPP2. Think chambers of commerce and trade groups and things like that. Eligible costs, these are very similar to the first time around. Payroll costs, they have now been clarified to include group plans for life, disability, vision, and dental. They include mortgage interest, rent, utilities, and they've added some new expense categories for work, such as worker protection. So like I was picking up food at a restaurant yesterday, and between the tables, they had the big plastic sheets. That would be protective equipment. Those would be deemed to be eligible expenses, gloves and masks that employees have to wear, et cetera, et cetera. They would also count. One thing that's kind of come clearer to us over the last month is that that if you are a company with affiliates, then Prasanna is going to go through this as well on the ERC side. We believe that you're supposed to go through the revenue test at the group level. So if you have 10 companies in your affiliate, you need to add the revenue of the 10 companies between 20 and 19 to see if you've got a drop in 25% or not. And we believe you need to pass that test, and then you can move on to the entity level to see which entities might be able to borrow money. Summary. PPP1 and PPP2, there's a lot of similarities. There's a lot more similarities than differences. But if you have any questions, please give us a holler. This is what we're here for. We're doing this on a regular basis with companies. There's no stupid question. This is complicated stuff. I got a question last night from a client that I thought was pretty clear. It's not clear to them. I got a call from somebody last week about something that I thought was sort of straightforward. It's not. This is hard stuff. And if you have questions, let us know. We will continue to monitor this. Thankfully, over the last 3 or 4 weeks, we haven't had a lot of new guidance. In one respect, that's good because the goalposts haven't been changing. We were hoping for some guidance on some items that we didn't get guidance on, and maybe we will going forward. But I think most people are beginning to think this is it. What the rules we have now are the rules we're going to play with for the rest of the way. So any questions, please don't hesitate to call us. So I'm going to turn it over to my friend Prasanna, and he's going to take over the tax side of the PPP and ERC.
Thanks, Marty. That was a great job. So let's talk about the PPP first. And just to give a 30 seconds background with regards to this, when the CARES Act was originally passed, Congress specifically included language that said that debt upon forgiveness would not be considered taxable. But they didn't say anything about the expenses. So the IRS tried to fill this blank up by saying, since the income is not taxable, the expenses associated with that income should not be deductible. Congress was against this position right from the beginning, and they asked IRS to reverse the notices that it had issued regards to this topic. But since the IRS refused to do so, they fixed it in the Consolidated Appropriations Bill, and they expressly added language that would make the expense deductible both in PPP1 and PPP2. So in numerical sense, what does that mean? So if I borrowed $1 million worth of PPP loan, the IRS was of the position that you would have $1 million of non-deductible expenses. But with this bill having been passed, you're going to be able to deduct that $1 million worth of expenses, giving you a $300,000 to $400,000 benefit based on the tax bracket that you belong to. So we do have a favorable outcome from a federal standpoint. And we talked about it at the last webinar as well, but there isn't a clear answer yet from a Massachusetts standpoint or from the state standpoint. Here in Massachusetts, for corporations, we follow what is called a rolling conformity. What that really means is that for C Corps and S Corps that pay entity level taxes, we would follow the federal rules. So since it's the expenses deductible from a federal standpoint, it would be deductible from a state standpoint as well. And the income wouldn't be taxable in either of those cases. But in an individual standpoint, what we follow in Massachusetts is called a fixed conformity. So what that means is that Mass follows the Internal Revenue Code as of January 1st, 2005. So, and back in January 1st, 2005, forgiveness of debt creates taxable income. So we have to keep an eye on this from an individual standpoint. So this applies for self-employed people or for partnerships or for flow through S corps, so where the income flows through to the individuals. This is still an issue because this is the forgiveness of the income is going to create, forgiveness of the debt is going to create taxable income. For people who haven't gotten the debt forgiven at the end of 2020, this is a 2021 issue. But if you received your forgiveness before December 31st, 2020, which a lot of our clients have, that it's a 2020 issue. So philosophically, we might have to kind of extend your return to see how this plays out in Massachusetts. They would have to pass some sort of a bill in order to make this not taxable. So again, going back to the numerical example, if you had $1 million of loan forgiven, Massachusetts wants to tax that, which would result in a $50,000 tax in Mass. So hopefully Mass will, there have been some indications from the Mass Senate and stuff. So in terms of that they are going to pass a bill, but they haven't done it yet. So overall, that's where we are at. Best possible result from a federal standpoint, but not quite there from a Massachusetts standpoint. So we'd have to kind of keep an eye on that. The other thing that they made it pretty clear in the Consolidated Appropriations Bill is the basis step-up issue. So if you have $1 million of loan forgiven, then you have $1 million of tax-exempt income. There was some questions from people in the industry whether that creates additional basis for the partners in the partnership and the shareholders of the S Corp. So they made it expressly clear that it does give you a basis step up. So what does that mean? What that really means is that if you have $1 million of a PPP loan that's been forgiven, you get a step up in your basis. And what that means is that you can take out $1 million of additional distributions out of the S Corp or the partnership tax-free. So that's where we are at from a PPP standpoint. The second most important piece of the appropriations bill is the employee retention tax credit. There are two parts to this, one for 2020 and one for 2021. And the rules, it would be great if the rules were the same, but unfortunately the rules are different for 2020 versus 2021. So let's talk about where the ERC rules are from a 2020 standpoint. Previously, when they had passed the CARES Act, they had said that if you took out the PPP loan, you'd not really be eligible for this employee retention tax credit. But they reversed that in the Consolidated Appropriations Bill, and they said that it applies retroactively. So I would recommend that if you didn't look at the PPP, if you didn't look at this ERC credit, that you should look at this now. And let's just talk a little bit about the rules. The credit is essentially $5,000 per employee for the whole of 2020. And it applies if you have less than 100 employees, full-time equivalents. If you have more than 100 full-time equivalents, it only applies if you paid someone when they're not working. And if you satisfy one of these two conditions, you would be eligible for the ERC credit. The first thing is if your business was fully or partially suspended because of orders, because of the government mandate. So that would be primarily gyms and restaurants that would fall under this category. Or if you had a 50% drop in your gross receipts in any quarter in 2020, when comparing it to the corresponding quarter in 2019. So if you had so most people would fall, not most people, but a lot of people would fall under the 50% drop in revenues category. So if you did fall under that 50% drop, then and you took the PPP loan, you probably didn't look at the ERC credit before. So that's something that you need to look at more closely. Even though this is a payroll tax credit, we can help you figure out, because there is some interplay, which I'll talk about in a little bit. We can help you figure out how the calculation would work so you can maximize both. In terms of ERC credit 2, for the ERC credit, even though the PPP 2 is more restrictive, the ERC2 is more easier to get. Instead of the 50% drop in revenue, you only need a 20% drop in revenue in 2021 as compared to 2019. So it could be a higher benchmark to follow. So for example, if Q1 of 2021, your revenues are 20% lower than Q1 of 2019, and Q2 of 2021, if your revenues are 20% lower than Q2 of 2019, you would be eligible for the ERC credit. They also upped the number of employees. In ERC1, you needed to have less than 100 employees. For ERC2, you need to have less than 500 employees. And the amount of the credit is better as well. So the maximum credit for ERC1 was $5,000 for the whole year. For ERC2, the credit is $7,000 per quarter. So philosophically, you have a $14,000 in the table per employee. So if you have 50 employees, we're talking about a $700,000 credit. Obviously, you cannot double dip and triple dip with regards to it. So if you're claiming the ERC credit, you cannot use the same wage for PPP purposes or for like research and development credit and stuff. And also the affiliation rules can be a little bit complex. So if you are an owner or control multiple entities, you need to look at the 50% or 20% drop in revenues at the group level and not just the individual entity level to figure out if you qualify for the credit. The IRS rules require that the entire group has to pass the revenue reduction requirement. If the group fails, none of the affiliates are eligible. But if the group passes, then the test needs to be done at each entity level as well. So that's where we are at from a ERTC 1 and 2 standpoint. In terms of the interplay, so this is where it becomes really interesting. If you qualify, like if you had a 50% drop in revenues and you haven't applied for the forgiveness, or if you have a 20% drop in 2021, and you are applying for the PPP2, or you applied for the PPP1, if you paid an employee, let's say, just to kind of put it in numerical sense, if you paid an employee, say, $30,000 in a quarter, you have to use the first $10,000 towards the ERC wages, and then you have the remaining $20,000 for PPP forgiveness. But there is more flexibility within the PPP wages. You have to use only 60% of the loan towards wages for full forgiveness. So in my $30,000 example, you can use only $18,000 towards wages, provided you have $12,000 of rent, utilities, and other includable expenses. So even though you'd be working with your payroll tax or payroll service provider in order to claim the credit, if you are eligible, if you had a 50% drop in 2020 or a 20% drop in 2021, I think there is going to be an opportunity to do some number crunching there to figure out how to take advantage of both programs and maximize the opportunity out there. And I think that's where the rubber meets the road. We've had a lot of calls with a lot of different clients. And I think Marty and I would be more than happy to talk to you about how to make sure that you're maximizing both of the opportunities out there. With that, I'm done with my piece of it. And if we are happy to help answer any questions with regards to this topic. I'll look at the chat, start off with the chat box here to see if there are any questions that we can help answer here. Can you send this PowerPoint presentation to the attendees email? Yes, we can definitely do that. If you email us, we also have gonna put this in YouTube. So if you would like the video presentation of it, we can send you a link of that as well. The second question here is, we have an SBA loan. The monthly payment auto withdrawal stopped shortly after PPP1 was in place without applying for anything. The withdrawals resumed 6 months later. After PPP2, the withdrawals have stopped again without applying for anything. Is this considered a loan? Do we have to pay this back or file loan forgiveness paperwork? I presume you're talking about the 7A loan. Mario, do you agree?
I think that probably is it. And I'm going to tell you, I'm not an expert in the 7A loans, but
I don't believe you have to apply for the forgiveness separately, but we can definitely take a look at that. I believe that as soon as the money is paid by the SBA on your behalf, it automatically becomes, it is tax exempt, but in theory, it becomes income to you.
So in other words, on these 7A loans, the SBA, for how many months last year was it?
It was 6 months.
6 months, and I think they're going to do 3 months in 2021. The SBA is, I think, physically paying the banks off for the payments that the borrower was responsible for, and the borrower doesn't have to pay anybody back anything. So, I would agree with what Prasanna said. I hope that's the fact pattern that the question was about.
10 months to file for forgiveness. What is the start date, date of filing, date of fund flow, or the date of the promissory note? Do you want to take that?
Well, the covered period, if in PPP1 you pick the covered period, that would be the date that you got your money in your bank account. If you pick the alternative covered period, it would be the first day of the next pay period after you got your loan. So if you got your loan on April 20th, and that was on a Sunday, and your payroll starts, the next period starts on April 25th, you could pick April 25th as your start date. So you could either pick April 20th or April 25th. Then you'd go 24 weeks from that date, and that would be the end of your covered period. And then you'd have 10 months from there to file the forgiveness forms. And I mentioned earlier in my comments that we would recommend, if you are not eligible for for the ERC credit, then don't wait to file your forgiveness form for the PPP. If you believe you're eligible for the ERC credit for 2020, you might want to hold up on your forgiveness form a little bit until you talk to us to figure out how many dollars of payroll you should put on that forgiveness form and how many dollars of other non-payroll things you should put on that form. Did I say that right, Prasanna?
Yeah, totally. The next question here is, I have not applied for the 2020 forgiveness and have received my second PPP today itself. Should I now apply for the 2020 forgiveness? And Marty just, I think, covered that. If you think that you're eligible for the employee retention credit for 2020, then I think we should talk about it before you apply for it so that you're maximizing your employee retention credit as well as getting 100% forgiveness.
I agree.
Can you repeat the revenue qualification for 2020 ERC? Is it a 50% reduction for the whole year or is it any given month? So we've had several questions on this. It's on a quarter by quarter basis. It's not a rolling 3 months, but it's just got to be, you got to look at your Q2 revenues for 2020 and compare it to Q2 revenues of 2019. And same thing for Q3 and Q4. You got to compare it to the corresponding period in 2019.
And if you're looking at your ERC calculation for 2021, that was extended through June 30th, as Prasanna said. So you can get an ERC credit in Q1 and Q2 of 2021. You're going to compare those 2 quarters back to the Q1 and Q2 of 2019 and not 2020.
Right. How do we claim the ERC for 2020? Do we file an amended 941 or are we still waiting on IRS guidance? Yes, we'd have to file an amended 941 to get this money back. Philosophically, you have 3 years to file an amended 941, but if you think you qualify, you obviously want to do it as soon as possible.
I agree.
How do I know if I'm eligible for ERC? So I think the first step is in 2020, if you have less than 100 employees, what I would do is put together your quarterly revenues and see if you have a 50% drop in any of the quarters. That would be the first step. And if you did have a 50% drop, then I would suggest that you guys give us a call and then we'll try to figure out how the interplay of the ERC and the PPP work together.
Prasanna, I think I'm going to say this right, but correct me if I'm wrong. The other side of that test is, as Prasanna mentioned earlier, is if you have been shut down partially or fully by the government. So I was talking to a client the other day, and they're like a daycare kind of for certain types of individuals. The government said you can't have these people all in the same place. So they effectively shut down the business for, I don't know, I can't remember how long it was, a month or something like that. So I believe they would qualify for the ERC credit in 2020 because I don't know if it was Governor Baker or whatever came in and said, you can't congregate these people anymore. And restaurants, as Prasanna mentioned,
Restaurants,
gyms, they shut them down. So in that situation, I don't think you have to pass the 50% test, do you, Prasanna?
Yes. I would say the shutdown piece would be a smaller piece population, but the 50% could be a larger population.
Yeah.
We are starting to get close to the 10-month cutoff, but our bank's portal is not ready to receive applications. If the portal is not working, what do we do?
Wow. I've never heard that before.
Would we be close if you were using 24 weeks as opposed to 8 weeks? I would think that most people would be still far off.
Yeah.
If they were using 24 weeks.
Yeah, I think that's a good thought. So whoever wrote that question, if you're using 8 weeks, then you've just accelerated by 16 weeks the number of the time you have to file your forgiveness. So you might want to go back in and change your forgiveness to select 24-week covered period. And I think most people's covered periods, I mean, most people got their money in, I think, early April, right? Prasanna is when people started getting them.
Yeah.
Maybe through the beginning of May. So then you fast forward from the day you got your money for 24 weeks, then you go 10 months from there. So I think you're onto something, Prasanna. So whoever wrote that question, if you're picking 8 weeks, you might want to pick 24 weeks. You'll get yourself a couple more. You'll get yourself 16 more weeks to have your lender turn its portal on. Does that make sense, Prasanna?
Yeah, totally. Yeah, I agree. The next question is, we qualified for PPP1 and filed for forgiveness in 20. For PPP2, we were off in revenues 20% quarter over quarter in 20 versus 19. The problem will be a big drop off in revenue for 21 versus 20 because our mills are not producing enough products to supply us due to COVID restrictions. What can we qualify for? So when you're comparing with regards to the employee retention credit, I'll answer from an ERC standpoint, and Marty, you can do it from a PPP standpoint. From a ERC standpoint, you should be comparing your Q1 21 revenues to Q1 of 19. And if you have a more than 20% drop, then you should qualify for the employee retention credit. And do you want to kind of talk about it from a PPP standpoint, Marty?
So can you go over the fact pattern again?
Yeah, let me read this again. We qualified for PPP1 and filed for forgiveness in 20. For PPP2, we were off in revenues 20% quarter over quarter in 20 versus 19. The problem will be a big drop off in revenue for 21 versus 20 because our mills are not producing enough product to supply us due to COVID restrictions. What can we qualify for?
Well, to the best of my knowledge, I don't know if PPP covers that fact pattern, because PPP2 says you compare 2020 quarterly receipts to 19's receipts. Right. And I don't remember any conversation about 21, but do you have a different thought?
I think from a PPP standpoint, for PPP2 standpoint, you'd have had to have a 25% drop in 20 versus 19.
Right. So I don't think you're going to you're not going to qualify for PPP2. I don't believe. I can take a look at that. Whoever wrote that question. Do we know who that came from so we can go back? I can. Yeah. Okay. And you know, there's nothing that says that we're not going to have a PPP3. You know, we have a change in administration, and who knows that we may be putting out more money. And we'll have to see what happens here with the economy over the next few months and rolling out of the vaccinations. So
Okay.
I'll take a look at that.
The last question here is, you state most people will use 2019 average payroll for PPP2 because payroll would be higher in 2019 versus 20, yet guidance says the lesser of 19 or 20. Wouldn't that mean most would have to use 2020?
I did not know it. I'm not familiar with the lesser of 19 or 20. I always thought it was 19 or 20. And that most people would use 19 because they've already done all the calculations and their bank has all that information. I will double check. Do we know who wrote that question too?
No, I don't. It's an anonymous attendee.
Okay.
We actually
We
do
can
know.
send out a general note.
chat. If you look at the
I'll have to look
chat,
at that.
Donna,
Prasanna, do you know,
it was restated.
have you heard of it, lesser of the two?
No, I have not.
Okay. I will look at that as soon as we finish here.
Okay. Those are the only questions in the chat box. If anybody has any questions, Greg, can you see if there is any hands raised?
And they could ask it live.
I don't see any hands raised.
Okay.
So we have a couple of questions to look at, the last two questions. And we'll get back to you all about what we think the answers are to those. And we appreciate your attending and your questions and your attention. So, and please feel free to contact anybody at Stone Digon to help with any of this. We spent a lot of time with a lot of clients helping them navigate through this. And clearly the PPP and now the ERC is helping a lot of businesses stay funded during this problem time and keep their employees employed. So it's worked. It has its faults, but on balance, I think everybody is pleased with what the PPP program has done. And you know, also in your, just because we got a couple of more minutes, I mentioned this earlier. Documentation is so important. You need to document your files. Okay, if PPP one loan was more than $2 million, I believe there are 32,000 companies that got that amount of money. They are going to be audited. At least that's what the SBA says. Now, the SBA is not a huge company. They don't have a huge band of people who run around and audit these companies. But if you got a loan more than $2 million, you can expect a visit from the IRS, up from the SBA, to validate that you got the right amount of money, that you did deserve the money. Document your files, especially that economic uncertainty thing. And any of your calculations defending your full-time equivalent drops and all that stuff, document everything. Whether you send that off to the bank, if it's not required to be sent to the bank, document your files. And if you haven't filed for forgiveness, take another look at the EZ form. If you have less than $150,000 loan in either PPP1 or PPP2, you can file the, I think it's 3508 simple form for forgiveness. Then there's an easy form, which is a little bit more difficult. And then there's a long form. And the rules for filling out the easy form, if you can qualify for those instructions, your completion of that form to get your forgiveness is a lot less work than the long form. So document, and give us a call if you need help.
Thank you, everybody.
All right. Everybody have a great day.